Okay, I think people are starting to filter through. Okay, so again, welcome to the session. Today we're going to be talking about how to start investing with Saxo, specifically how you can, get started with building a portfolio. Your host today is Charu, not myself. She'll be on in a second. She's the main speaker. Charu is an expert in this stuff. She's got over 15 years of experience in the financial markets. Her role at Saxo is really delivering like strategy based on global markets, fundamentals, a lot of the stuff that goes on day to day. But you'll also see her regularly if you watch channels such as Bloomberg, CNBC, and BBC, etc. So you are in safe hands. I just want to raise a couple of points before we start. So we do want to make this kind of interactive in some way. So you can ask questions. There is, if you're on mobile, the question box will be around the bottom of your screen. If you're on desktop, it's on the right. But there is a question box, so feel free to add those. And if you ask them along the way, then we will try and answer them along the way too. If you want to ask them at the end, then there'll be space at the end for questions there as well. Also, in terms of the recording of this webinar, you can watch this again afterwards. So the same link you guys use to join, you can use to watch this on demand at any time later down the line. And you'll also find a recording within the Saxo platform. And then finally, the slides that you're about to see, they are available for download. So there's a handout section within this webinar room too. There's a PDF in there. Just click on it and you can download them and check them out at your own pace. Well, that's it from me, really. I'm going to hand you over to Charu.
Right. Thank you, Luke. And hello, everyone. Thank you for joining us today. I'm really thrilled that so many of our attendees are filtering in as we start to speak. And so many of us are ready to really take control of our financial future. So as Luke has already introduced me, I am Charu. I'm based out of Saxo's Singapore office. So it's just after 8 p.m. here. So if you see me dozing off, please excuse. Luke will take over that then in that case. But before that happens, I think let's just kick it off. We will obviously be talking about how to build a portfolio. But before we get there, I think just a word of disclaimer. Anything that we talk today is only for information and education purposes only. None of this is investment advice. So obviously always do your research before investing. As we talk along, I will be taking names of some of the products, some of the instruments that you can use for investing, but I will continue to reiterate the fact that these are not investment advice, and the names that I'm taking is actually only to make you guys familiar with it. So I think that's one very important point to consider before we start. We have a broad agenda for today. We are obviously going to start with the building blocks of a portfolio. I think the most important aspect here is to understand what financial goals you have. So I think that is a starting point, which we probably have already covered in one of the earlier Saxo investing sessions over the previous weeks. But today we're going to understand, what your risk profile looks like, what kind of assets might be suitable for you depending on your risk profile. We're going to talk about diversification and how you can do it in very, very actionable ways. We're going to talk about, this constant question that I keep getting whenever I do such educational sessions is, particularly about, the market is at all-time highs right now. So is it a good time to invest now? And we're going to obviously look at how you can start your first investment, what kind of stocks you can select, what kind of ETFs you can select, and what are the things, key factors that you should particularly look at when making such decisions. So I think let's just dive in. We are going to start with, as I said, what really is an asset allocation. So asset allocation, simply put, it is how investors divide their portfolios between the different assets that might include equities, fixed income, cash, funds, and things like that. Ordinary, circumstances, this just means that you are balancing your risks and your rewards based on your financial goals, based on your risk tolerance and your investment horizon as well. So why are we dividing our assets? Because every asset class has its own specific risk and return potential. So each of them will behave differently over time. I mean, you've already obviously heard the saying probably that goes like, don't put all your eggs in one basket. So I think that again goes to say that how important diversification is in investing. And this is what really asset allocation helps you achieve. It helps you to diversify your risks. It helps you to balance your risk and reward. There will always, of course, there will be market risk whenever you invest. The risk that the entire market will decline, for example, what we saw during the global financial crisis, for example. So even the most diversified portfolio, even the most, I would say, conservative portfolios, even those would have probably taken a beating because all the asset classes at that time fell in tandem. But of course, if you are diversified, you have a little bit of a more conservative portfolio, then the losses are at least a little bit more, measured compared to a portfolio that is completely focused on, say, equities or riskier assets, for example. So the bottom line is that the risk cannot be completely eliminated when you're going into the markets and investing your money. This is something we need to understand. But clearly, I mean, then the other solution is that you only put your money in a savings bank account, which is obviously also not ideal because then over time inflation is eating into your savings banks savings money, so it continues to outpace the interest rates right now, and eventually it results in you losing your purchasing power as well. So we're going to try to understand what asset allocations are suitable for what kind of profiles. I mean, just very simply put, I mean, most of us have probably heard the optimal asset allocation being a 60-40 portfolio, which means 60% allocated to equities and a 40% allocated to bonds. But I would say that there is really no one answer to this. I mean, you would probably find a lot of research that goes to say that 60-40 portfolios are outdated, don't make sense to all kind of people. So there's a lot of arguments for and a lot of arguments against it as well. There is no one answer for all, and there is no static answer also. You cannot just set it and forget it kind of a decision. Your asset allocation has to be very, very dynamic. You need to obviously keep going back to your portfolio to review it, to adjust it, and to understand how you want to adjust your asset allocation to for it to better reflect your current circumstances. So I think that is really important to understand. But then, how do you really decide your asset allocation, right? Like us.
There's a quick question on how much money would you need, would you say, to start? I guess it's probably not a lot to start, but how much would you realistically need to start investing?
I would say, I mean, given these days there's this plenty of brokerage platforms, they allow you to start with as little as $100, even less perhaps. I think there is no set answer to this. It is really based on your circumstances. When I do these sessions, I do such sessions a lot with women here in Singapore. We talk about budgeting, and we talk about a 50-30-20 kind of a split in your budget, where 50% is what goes into your needs, 30% into your wants, so those are your expensive, and the leftover 20% is basically something that you should ideally, so 20% of your income is something that you should ideally invest. But again, this is not something that is applicable to everyone. It is going to be dependent on your situation, but the key is to start early, the key is to be consistent, and the key is to be patient. I think these are a few things that I will keep repeating as well as we go through the rest of the slides.
Okay, thank you.
Going back to what I was saying is, how do you really decide your asset allocation? I mean, again, I'm guessing here that all of us here have a good idea about our financial goals. That is obviously an important aspect to understand how much money you need and what is your investment time horizon. Say, for example, you're trying to meet some different goals: retirement, education for your kids, maybe to buy a house. So all of those goals will have a different time horizon and a different amount that you need to draw from your portfolio, from your investments, to reach those goals. When you have a clear idea about what kind of returns you want to generate, the next step is obviously to understand what kind of a risk are you willing to take and how prepared are you really to lose a part or even all of your capital in some circumstances. So you need to really understand your risk appetite, your risk profile in this case. I would say the two big aspects that determine your risk profile, they are the ability and the willingness. So the ability is a little bit more easy to understand. It is your time horizon, which will depend particularly on your age. There are other factors also that could go in, your ability of how much risk you can take, something like how much income you generate, do you have family wealth, things like that. So I think more quantitative, more easy to understand kind of factors, they will determine what your real ability is. So if there's a person who's in their 20s, they can remain invested for 30 to 50 years. If they're obviously trying to achieve a retirement goal, they have a good 40 plus years in hand to really reach that goal before they really need that money back. And that is why they have that ability to take more risks, so they can go into more aggressive investments compared to obviously somebody who's just 5 years away from retirement and they no longer want to take the risk of losing their capital, even if that means that it comes at slightly lower with slightly lower pace of return. So they want to stick with potentially more conservative kind of investments. And the willingness is basically your risk tolerance. It is a more difficult aspect to answer, but I will come to that in the next slide as well. So when I'm talking about the time horizon, as I mentioned, age is a big factor to understand your time horizon. But I was lying. Actually, age is not the only factor. In fact, age is not the factor. What really matters is how far you are from achieving your goals. So remember, you have different types of investment goals to reach. If it is for a house, say you want to buy a house, so you need $1 million in 2 years, then your time horizon is short, even if you are 30 years old, right? I mean, you have a lot of age left to kind of grow your wealth, but you need $1 million in 2 years. So you want to take less risk right now because you're approaching that goal pretty soon. So it's not really the age, it's the investment time horizon. And the closer you get to your goal, your risk profile gets a little bit more conservative in that case. And how I personally do it is, I mean, I think of it, I think of each of my financial goals as a different portfolio and with a different risk profile. So my portfolio, say for buying a house, is maybe conservative if the time horizon is less, but my retirement portfolio is a little bit more aggressive, for example, because as you can probably not tell, I'm not that old. At least that's what I would like to think. So I have enough time to really grow that retirement portfolio. So I managed to take a little bit more risk on that side. And still, I mean, if you want a little bit of a starting point, that's a chart I put on the on the right hand of the slide. I hope my image is not covering that. But there's something called a rule of 100, which is the 100 minus the age, which tells you your asset allocation. Again, this is just for reference. It will again depend on how much risk you want to take. So if you're using the age, the 100 minus age rule, so what that means is if you're 20 years old, you put 20% in bonds and 80% in stocks, and if you're 30 years old, you put 30% in bonds and 70% in stocks, and so on. As you age, basically you cut down your risk, so you reduce your equities and move towards bonds a little bit more. But I mean, as you can see, there's 100 minus age, but there's also 110 minus age, 120 minus age. And the reason is that over the past few decades, a lot of things have changed. Um, for example, the life expectancy in many countries has gone up. So, we have obviously more years to live. And not only do, we have longer years, what also happens is that now the bond yields are not, I mean, now we've seen bond yields go up again, but over the last several years, the bond yields were very, very low compared to the 80s when bond yields were somewhere around 10%. So we're now about 4-5%, which is still low compared to the 80s. So the bonds don't generate the kind of returns that they used to generate at that point of time. And of course, if you are living for 120 years now, then you don't want to run a risk of running out of whatever wealth you've generated and being really with nothing in the last few years. So I think these are several factors. We've come up with these new rules now: 110 minus the age as well, 120 minus the age as well. Many of the consultants are now using, many of the target fund managers who kind of have funds with a target age in mind to help you reach your goals within your time horizon. They actually use the 110 minus your age or the 120 minus your age kind of a rule for a little bit of a higher risk tolerance.
I got a quick question for you, Cherry, on this. So if you didn't invest in your 20s, then looking at this chart, would you be better off moving to a more aggressive or moderate risk profile?
If you did not invest in your 20s, it
Yeah.
certainly means that you have less of a time horizon. But again, Luke, I would say this is with respect to a retirement goal. All of these things are set up with respect to a retirement goal, but that's not the only goal that we have, right? I mean, even in my 20s, if I was 25 and I wanted to buy a house before I was 30, I would still have to be conservative, right? That's what I'm trying to say earlier on as well. But again, this is if you've crossed the 20 mark, I don't think it's very late as well, given how equity markets are charging ahead these days. Probably you can cover up for the lost time if you continue to stay consistent. The other strategies are obviously top up when you can, you get a bonus and you top up your portfolio. I think all those things, the compounding really works in your favor. So what you've lost, the time that you've lost cannot come back, but you can make up for it in other ways by being consistent, by being a little bit more aggressive.
Okay.
And so this was the ability aspect of your risk profile, right? And the other aspect that I mentioned was the willingness aspect as well. And again, like I said, that was a little bit more difficult to understand. It is basically how a person reacts to different situations. So I try to break this down using a few everyday examples. Think about how you approach other areas of your life, like say driving or planning your holidays or even cooking. Some people, they like to take their time, they like to avoid stress, and while there are others who kind of push the limits, they try to get the results faster in limited amount of time. So I think these are the two, broadly speaking, two different types of personalities. So if I was to take the example of driving, I mean, if you have to drive, say, 100 kilometers, would you prefer to go safe, drive a little bit slower, say maybe at 50 kilometers per hour, and rather take longer to reach your goal? So you take 2 hours, or would you want to speed up to 100 kilometers per hour and then try to reach your destination in about 1 hour, accepting the fact that it does come with its own risks as well. So I think there are plenty of such examples, whether you want to, when you're planning for a holiday, do you want every detail of the vacation planned out before you head out, or you kind of leave it on the go? You want to just go and see what kind of an adventure the place offers to you. So there's plenty of scenarios in your daily life that you can look at to understand, are you a risk taker or are you a little bit more risk averse? This is your natural approach, and investing just works the same way as well. Some of us, we are more comfortable with more risk, hoping for higher rewards, while others, they prefer to play it safe and then they aim for a little bit more steady growth instead. So broadly speaking, what you need to know is whether you want to be conservative. That is, you do not want to risk losing your capital at all. Then you need to obviously stick with some very low risk investments, even if that means you may not grow your capital by too much. Or are you a little bit more moderate? You are okay with some level of risk. You want stability, but you also want growth at the same time. So you want to balance the two objectives. or whether you are really on the other end of the spectrum, which is you're really aggressive, you're okay to take high risk to get that high return, even if that means that you could, even lose your capital. So I think that is basically, it's like a spectrum. There's no one or two or even three aspects to it. You could be anywhere in that spectrum itself. Now, once you have some idea about how much of a risk taker you want to be, the next thing you need to know is which assets should I invest in? Okay, I'm a moderate person. I want to take some risk. I want some stability in my portfolio, but I also want to aim for growth. Remember, it's the asset allocation that we're talking about. You probably know what allocation you want, but we also want to understand what are the assets that really provide me with those kinds of a mix, or those kinds of risk profile that matches my risk appetite. So here you go. I mean, again, this is a very broad outline. I've covered some of the key assets classes that we usually talk about, usually invest in. Of course, there could be a few more things here as well, but depending on whether you're conservative, moderate, or aggressive in your risk tolerance, your asset allocation will look quite different. So here I'm breaking down the types of investments that tend to suit each of the risk category. If you're a conservative, you generally stick with cash or bonds, mutual funds, which are professionally managed and are well diversified. And then moving along the spectrum, if you're a little bit more moderate, you probably want to add in some of the asset classes that bring a little bit more growth potential, which are stocks, which is real estate. Potentially, real estate could be a little bit more risky as well. And then again, as you move further along the spectrum, you are more aggressive. You probably want to add some alternatives, commodities, even crypto, hedge funds, things like that as well. So I think that's just a broader understanding. As you can see, if you're more risk averse, you'll likely prefer assets like cash and bonds. If you're moderate, probably a mix of bonds and equities. And equity is still a little bit more stable, dividend paying, blue chips. We're going to talk all about all of that as well later on. And for those of you who are willing to take more risks, then maybe even thematic investments, real estate, commodities, venture capital, crypto, and so on. Okay, now that we've covered these different types of assets based on your risk profile, let me ask you this. Would you feel comfortable putting all your money into just one type of investment? Say, I mean, I understand I'm moderate. Should I just pick up stocks and ETFs and put everything in one ETF, one or two stocks? I mean, that's going to be a tough one, right? Again, so what you really want to do is diversify, right? I mean, the key takeaway here is no matter where you fall on the risk spectrum, it's not a one asset class that kind of resolves or responds to your particular risk profile. There's a tailored mix of investments for you. And it's all about really finding that right balance that fits your profile. Remember, don't put all your eggs in one basket. So, what is diversification? I'm sure all of us have heard this term. It means spreading your investments across different asset classes, across different sectors, maybe even geographies. In fact, even more, we will come to that. But basically, trying to manage risk. So, by diversifying, you're not relying on the performance of a single investment. If one of your position is struggling, then another one might be thriving, and then that helps you to balance out your returns. So diversification is certainly one key tenet of investing. It is talked about a lot, often not well understood enough, I would say, but certainly a very common term. What I would like to highlight here, though, is diversification is often talked about in the sense of risk management, right? They always say diversify so that you don't lose everything. Diversify so that everything doesn't go down together. However, what is very often overlooked is that diversification can also help you to discover the winners of tomorrow. It can position you in areas where you might not have initially seen some opportunities. For instance, I mean, if you were primarily invested in, say, technology stocks, you might miss out on potential gains in other sectors, like, say, renewable energy suddenly starts to boom. And if you have no exposure to that, you're just concentrated on the technology side of things, then you're missing out on that, right? But if you try to balance your technology, from the sense of diversification, okay, let me not have everything in technology, let me buy a little bit of renewable, you could see that surprise coming through in your portfolio at some point of time. So, basically, this is something that Peter Lynch has said. He's a very famous investor. He says, diversify. If you obviously want to boost your chances of finding more winning stocks in your portfolio as well. But it's important to understand that you should diversify only into businesses that you know. You have something that you have a strong conviction for. If you're just following the definition of, the book definition of diversification, buying a stock in each sector, you may actually be also increasing the risk of your portfolio, not really reducing it, because you're buying into businesses that you don't know that well as well. So it's important, but it's important to have diversification in a very active way, to understand why you are diversifying, what are you trying to diversify, and so on. So how do you really diversify your portfolio? Is having 5 stocks a diversification? I don't know. Is 3 stocks and 1 bond a diversification? What is diversification? How do you really understand that? So let's look up that in a little bit more detail here. So there's several categories, of diversification. Those that are the most well understood, particularly, diversifying across asset classes, like we said, stocks, bonds, real estate, commodities, private equity, alternatives, things like that. So you basically do different asset classes with the different risk attributes, so that you have all of that in your portfolio in a specified allocation matter. What is also well understood is diversifying across sectors. So there are 11 sectors in the S&P 500. You could have maybe all, or at least more than 2 or 3 sectors, some stocks from those different sectors in your portfolio. You could also look at it from a dividend versus a non-dividend part of S&P 500. Some of the common dividend paying sectors are, for example, energy, financials, utilities, REITs as well. So you have some of those dividend paying sectors and some others that are non-dividend paying, but probably with other characteristics as well. Regionally, again, some of us are obviously very, very exposed to our local market. It's called a home bias. Others are probably heavily exposed to the US market, because that is, again, the largest market. So obviously balancing it out from a regional aspect is also important to achieve diversification. I think certainly there's some level of familiarity with local companies. That's why people tend to have that home bias. But obviously, investing in foreign equities is also now much easier because of the availability of information, of technology, and more uniform trading costs, as well as, you don't need to really pick a stock. You can invest in foreign markets with an ETF as well. So I think compared to many years ago, nowadays getting that regional diversification in portfolios is far, far easier. But beyond these typical areas of diversification, I think you should also analyze your portfolio in a growth versus a value kind of a breakdown. Growth stocks that don't often pay dividends, but they offer higher capital appreciation potential. They're obviously a little bit higher risk as well in that regard. Whereas value stocks, a little bit less volatile. They are more stable. They usually, I would say, pay dividends, and they provide more of a balance between, if you have both, you have a little bit of a balance between income and growth opportunities, both of them in your portfolios. Consider diversifying across the company sizes as well. So large caps, mid caps, small caps. Again, there are indices to do that. You don't really need to go and pick up a small cap company and expose yourself to that kind of a risk. There's a Russell 2000 index, for example, in the US, which actually is an index of the small cap companies in the US. I'm sure there are others as well, and within bonds as well. So you should not just look at sovereign bonds, but probably diversifying to corporates and high yields as well. So there's many different aspects of diversifying your portfolio, really. But of course, this might be getting a little bit overwhelming at this point. So maybe we should take a step back and simplify it. I mean, it's important, obviously, to make things simple, especially when you're starting off to build your portfolio. What you may want to obviously come back to this later on and think, what should I add to my portfolio now? I have enough of A, B, and C. Maybe I should look to add D and E this year. But so this is obviously important from that aspect. But as a starting point, I mean, I obviously think that it could get overwhelming if you want to think of having a portfolio to start with, which is diversified in all of these respects. So I'd like to give you two very actionable ideas for starting to build your portfolios, and then of course we continue to evaluate based on these criterias whether you're diversified enough or not.
Just a quick question on this one. So is it possible to over diversify, would you say? Can you go too far?
I think, in fact, the other problem with diversification is sometimes we think we are diversifying, but we are eventually buying things that are very much related. For example, especially tech nowadays, I feel like tech is impacting everything else, every other industry that we want to invest in fact, even if I'm trying to pick a healthcare stock, I'm thinking of it from a tech perspective, which ones are using AI in the healthcare industry. But eventually, does it mean should I just buy a tech stock and just keep that? Because if tech is growing, then everything else will grow. So I think that's one important factor. But over diversifying, certainly, again, could be a problem, specifically if you don't understand the businesses. Like I said, Warren Buffett usually says that, and he's such a popular investor. I do follow him a lot, but he's never diversified. No, I mean, I think the other aspect of this is really to understand the businesses, have a strong conviction about them, and then really get onto that diversification bandwagon. I think the ETF proliferation has really made diversification a very loose thing, a loose concept, really, to implement.
Makes sense. It seems you can diversify when you look out there with like two things, like because they're kind of diversified themselves, but maybe that's not diversified enough. But I know you're going to come on to some examples now anyway, so I'll let you continue.
Yeah, let's jump on to, I mean, I really wanted to just kind of make it simple, because if you look at the slide, you'll think, oh my God, I can never invest, right? I mean, and that's not where I want to leave the attendees today. So, okay, let's jump on to the first, actionable strategy that I had. And this one is a very, very simple. It is called a 3-fund portfolio. Again, it's a very popular strategy, especially if you are a follower of the late Vanguard founder, John Bogle. He's written quite a few books. He values simplicity in investing, talks a lot about investment costs as well. I'm going to come back to it at the end of the session. But basically, what is a 3-fund portfolio? It typically includes one domestic stock fund, wherever you're located, whichever country. So an ETF that represents your local market, an international stock fund, which is either a US or a more diversified, in international markets. It could be developed markets, more particularly so developed markets. Again, specifically if you're starting, you don't want to obviously get into that emerging market spectrum, which is a little bit more risky. And the third one is a bond fund. So which goes into the fixed income side. Now you have diversification across different asset classes, a little bit across regions, and because you're using ETFs, you would expect that these will have diversification across sectors, across probably the growth and value styles as well. So there's quite a bit of diversification that you achieve with this kind of 3-fund portfolio. You manage risk and you also improve your potential returns. So if you're the conservative type, for example, this example, again, this is just for reference. It's not really any guidance, but if you are conservative, you want to have 60% in bonds, you put 60% in a bond ETF. The rest you can do half and half in local equities and then say US equities. If you're moderate, you reduce your bonds to half, so you go down from 60% to 30% in bonds. You have 40% in US and you have 30% in the local markets. And if you are a little bit more aggressive, and you're young, you don't have any near-term goals, financial goals to meet, You can obviously have just very little, 10%, 20% in bonds, for example, and the rest, all of the rest, 90% or 80%, whatever that is, in equities. Depending on if you think your local market is doing much better than the US market, you're much more familiar, much more comfortable there. You could have 60% locally, you could have the rest in US market, or vice versa. Remember, this is just a starting point. Key point is not the percentages here, really, but the idea that you can just choose 3 ETFs and still be sufficiently diversified, so to say. And then, of course, the key idea here is to have low cost index funds, ETFs within each category. So if you are a US based investor, for example, you might select a US total stock market index fund, an international total stock market index fund, and a total bond market index fund. Again, I'm going to show you these ETF names a little bit later again. There are obviously drawbacks as well. You could miss on high returns. You don't have any exposure to, some of the alternative asset classes, to commodities. There could be plenty of drawbacks as well, but it is a simple strategy. Beginners can create a diversified, a balanced portfolio that is easy to manage, and it has the potential for long-term growth as well with something like this. The second strategy that I'm going to share is a little bit more complex. It is called a core satellite approach, which combines active and passive investing in a way. So compared to that 3 fund method that we just talked about, which was very, very passive, this is a little bit more active in that sense. And that's why a little bit more complex as well. So you probably need to devote more time to this than you have to do to that 3 fund portfolio where you just buy and keep for your long-term wealth, keep putting in every month or however frequently you might want to, and you just leave it there. But this one, like I said, at least the core part, that is the stable part of your portfolio, that's the foundation of your portfolio. It is again diversified, tracks broad market indices across multiple sectors, multiple asset classes, multiple regions potentially. The goal there with the core is really to provide steady long-term growth, low volatility, and then again you just put it and forget it, like passive part of your portfolio. Not just forget it forever, but forget it for some days, months. You don't have to actively look at it every day, every week or so. And the satellites that I've shown across, these are the smaller, more actively managed positions that focus on specific sectors. They focus on specific themes or some high growth opportunities that you might see in the market if you're tracking the markets closely. These satellites, basically, they are meant to enhance the overall returns, to take advantage of market trends without really considerably increasing the risk of your portfolio. So, you might want to invest in AI, artificial intelligence these days. You've seen something breaking out from a technical perspective. If you have that, technical analysis kind of knowledge, then you've seen something breaking out, something approaching a resistance or a support. You want to add that to your satellite portfolio. You can do that. Or you want, like I said earlier, emerging markets, which are a little bit more risky. You want that exposure because obviously there's high growth potential, the kind of growth that China has delivered for many, many years, the kind of growth that India has delivered over the last 3 years. You want to add any of those, then you can bring that in your satellite portfolios as well. Obviously, these are smaller, more actively managed, and designed to capture opportunities for higher returns, particularly. And just to take you through an example of this as well, say this is a sample portfolio where core makes up 80% of your portfolio and the satellites make up 20% of your portfolio. So the stable part, 80%, passively managed. The satellites, 20%, more actively managed. The core part, is it's, if I look at it broadly, it's about 50% plus, 55% or so in equities, spread across S&P 500, local equities, REITs, emerging markets, developed markets, and then the 15% in bonds, 10% in gold, which is a safe haven. Whereas the satellite side, you see a lot of funds that are, which are a little bit more risky, a little bit more new age. But then again, these are trends that you never know when they're going to kind of die out or be overtaken by something else. So you put them in your satellite, some FX exposure, some bonds, some commodities exposure, some hedge fund exposure, and you put it there. So basically, this is a barbell strategy where you kind of balance growth and you balance income as well. So it gives you a good balance in your portfolio with little, I would say, time commitments, because you only have to manage that 20% of the portfolio on a very active basis, and the rest is more passive, where you rebalance frequently, but you don't look at it every day, every week or so. So, did you want to say something,
Yeah,
Luke?
as you move on to the next slide, it's a good time to ask a question. I know you're going to talk about, is it a good time to invest now? But we have a question from Catalina. I'll put it on the screen. Yeah, and this is a really good point, right? So you got all this uncertainty out there. There's a lot of stuff happening in the US. There's people talking about a recession. And it's like, what's the recommendation for new investors? And I guess it's to 2 points, like regards to this kind of moderate, conservative, aggressive approach. Should it change those, or should it change it? Well, what should you do with this kind of uncertainty?
Okay, I was going to come to it later on, but maybe we should jump onto it now, right? Let me just jump onto my slides. Oh, actually, here it is.
Yeah,
That is the next one, right? So, this is, like I said, I think right at the beginning as well, when I was showing you the agenda. You know what kind of an asset allocation you probably want now. You can start by building a 3 fund portfolio. You could be a little bit more aggressive and more adventurous and start with a core satellite approach. But you know, even if you give people all of these tools, there's always going to be some concerns, at least for first time beginners. Very, very natural, right? To kind of have that kind of a bit of hesitance to really go on and invest, because there's just so much overflow of information, of news, of headlines all the time, that it kind of tends to make you a little bit nervous about putting your money in at this time. So I get this question all the time: is this a good time to invest now? Sometimes it will be from a positive angle. People would ask, right, markets are at all-time highs, everyone says that they can't sustain these levels forever, so is this a good time to go now? And the other times, like you just talked about from that question, there was there's a recession coming, or Trump is bringing tariffs, or there's a pandemic, or there's a crisis, or there's a geopolitical, there's a war. You know, you get this question from both angles. If things are very good, people will be concerned about valuations. If things are not too good, you would be concerned about markets going down because of that as well. But as this chart really shows you, the market has historically always found a way to recover and to reward patient investors. Basically, this is to say that businesses really have adaptability and innovation that kind of continue to support their growth. Whenever there's been a crisis, obviously there are pullbacks. That is obviously expected. But then what comes next is really the recovery as well, and probably even significant amounts of growth. So, what we need to really understand here is that as a long-term investor, particularly, it is, I totally understand, very difficult to separate the noise from the fundamentals. As I said, there's a huge amount of headlines that kind of come in every day, but not every headline really impacts your portfolio in a big way as well, right? For example, we saw these Trump tariff announcements over the weekend, just this weekend, last weekend. They triggered immediate market reactions on Monday. A lot of things were going down. But does that really mean that the long-term fundamentals of many of the businesses that we have in our portfolios would change dramatically? Again, if I'm a long-term investor, if I've invested in strong businesses, I would think that the businesses continue to adapt. Yes, there could be some pressures, as you can see some downturns coming in these charts, for a particular stock as well. There could be some downturns, but again, they have the ability to really turn that around and continue to grow over the long term horizon. Remember, it's not about timing the market. It's really about how much time you spend in the market. What happens is, it's going to be an ideal scenario if I can just sell everything just before every downturn and then just buy at the bottom and then continue to enjoy the growth upwards, right? But even if I was to be able to sell my investments before the market starts to go down because I've seen the headlines coming and anticipated a decline, going back in is always going to be a big question. When should I go back in? When is the bottom there? So I think rather than missing out that time in the market, it's just for long-term investors particularly, better idea is to be patient, to stay disciplined, to stay committed to your investment strategy, and then just to navigate this volatility.
There's actually, it makes a lot of sense. You can never time the market. So there's a follow-up question here. Let me put it on the screen from Asan, which is, I guess it's a similar in some ways, but instead of worrying about the market as a whole, what about the most overstretched sector within it? We have the same approach to that. I mean, how would you put tech into portfolio anyway? It would be a part of your diversification?
So, I mean, again, we are not sharing market views here, particularly in this session. I'm happy to say that obviously tech is a crucial part of most portfolios these days. I think, I mean, particularly, I would say the last 10 years, obviously, if you have not been in tech, you've not been able to see the kind of growth that the market, your portfolio has not potentially been able to see the kind of growth that the market did. And that's why what I'm trying to say here is that now, again, obviously, at this point, there are concerns about tech being a little bit overvalued. And if you really want the strategy side of, a consideration here, we've written plenty of articles on our Saxo website and platforms where we talk about how obviously there are concerns about overvaluation in some of the sectors in the S&P 500, particularly the tech, and how the tech valuations are probably going to broaden out. So the tech story is probably going to broaden out. We've seen that with DeepSeek last week, where the launch of this Chinese AI platform really challenged the traditional winners in the US AI sectors, which does mean, again, that with this easy accessibility to these generative AI platforms, there could be more and more companies that could adapt to that and kind of really grow with that. So the AI story could really broaden out. But again, as a beginner investor, it is obviously it is not just about picking the right stock, right? I mean, we are going to come to picking the stocks as well later on. But if you're concerned about valuations and you want to stay invested, like this slide particularly shows that markets are volatile. Certainly, no one wants to lose their hard-earned money. But if you think the market is going to crash or a particular segment of the market is going to crash next month, then you don't want to put all your money in today. Then the other solution is that I think, yeah, I have it here. No one no one can say with guarantee that the market is going to crash next month, right? So you also don't want to just stay on the sidelines, and then that could obviously mean missing out on that long-term growth that is going to potentially come through. So how do you really continue to invest without worrying about timing the market perfectly? The one practical strategy, it is called dollar cost averaging. Many of you have probably heard of it. I'm giving an example here on the table on the left, where say you have about $12,000 to invest in a stock or an ETF. It could be applied to anything. It could also be applied to your 3 fund portfolios. And instead of going in all at once today, so if say the stock price is $100, you go in all at once today with your $12,000. You buy 100 stocks. Or if you're worried that the market could go down, then instead of investing the entire amount on day one, you decide to invest $1,000 every month for the next 12 months. So if you're just buying whole shares, for example, you will buy, say, 10 shares in the first month when the stock price is 100, 10 in the next month when the stock price is 95, but you are carrying over your cash. So the third month when the stock price is actually 90, you end up buying 11 shares. So what this does is that when the share price is going lower, you actually buy more of the share. So your average cost of that investment goes down over time. And of course, I mean, at the end of this, as you see, I've just taken some random share prices at the end of 12 months. You end up these are 125 shares. So you end up buying 125 shares instead of the 120 that you could have purchased if you had gone all in the first month itself. And then also you got these 125 shares at a lower average cost price of $96 instead of $100. So this is what the dollar cost averaging really does. It is difficult to predict market tops and bottoms, so it eliminates that pressure to get that timing right. You have a particular schedule, you avoid the emotional trap of chasing the highs or trying to sell at the lows, getting worried about the stock going down. It lowers your risk of investing at the highs, and it also takes advantage of really investing more when the market or when the stock price is a little bit lower. So this is just a very disciplined, consistent approach to investing if you're worried about the fact that I don't want to go all in right now because that is a huge amount of risk. Things can go the other way, anything like that. Then I think this is a very, very useful strategy for beginners. And the other key thing that we want to address today, I've been talking about it for quite some time now, is when you want to start building a portfolio, how to find the best companies in the world for long-term investing, really, how to find those quality stocks that provide stability during market downturns. They provide consistent returns over a long time horizon. So basically, I mean, of course, you have to do a lot of fundamental analysis and a bit of technical analysis as well if you're up for it. But what do you really look for? I mean, you look for strong financials, right? The company should have a steady revenue growth, high profit margins, a low debt profile, good returns it is generating. It is, there's a few different aspects. Of course, this also differs by which sector you're looking at. So accordingly, you look at the different financials, but you basically want to have a company that has a robust financial history, something that has competitive advantage. So what is a competitive advantage is something that Warren Buffett calls a moat. It's again a very common term nowadays. It is basically something with a strong brand, with patents, with network effects, with cost advantages, a huge market share, significant pricing power, things like that. So you're basically a leader in your particular sector, in your industry. Then a quality stock also comes with a very, very strong, experienced management team. As you will know, a management team is really important to continue to, ensure that those returns are delivered consistently over a long time horizon. And no matter how great a company is, just paying too much for its stock can obviously, I mean, even if the company is too well, but everything is priced in, then it will potentially hurt your returns at some point as well. So you have to keep all of these factors in mind. Now, again, this might start to look a bit overwhelming. Do I have to build huge Excel sheets and do some kind of financial analysis for every stock that I need to buy? Of course, not everyone at least has the time to do all of this analysis. And particularly if most of the people on this call, they're beginners and, if they could do all of this analysis before their first investment, that would be amazing. But what happens really is when you see such slides that you eventually go back and think and never really start investing. But I think again, so I just want to obviously keep this here because as you grow along in your investing journey, this might come handy. But for starters, there is again a very simple way of doing this is looking for moats or looking for blue chip stocks. Again, none of this is investing advice, just for you to kind of start considering as you are buying your first few, stocks probably. So blue chips is something that you must have heard of. It's a very common term. It's basically a brand that is very well recognized nationally or internationally, very well established, financially sound, usually a large cap stock with high quality products and services and huge market share, reputable brands which are household names potentially. something that has been around for many years, and has seen those economic cycles, has seen the economic downturn, something that has survived the global financial crisis, I would say. So that kind of gives us a sense that these would be stable investments. So long track record, I would say, is very important. Something that's been paying dividends. So you see a lot of the familiar names. Actually, if you just go Google or try to find out some what are the popular blue chip stocks, you'll see all these names come up: Coca-Cola, Walmart, Procter and Gamble, Microsoft, JP Morgan, so many of them, right? And again, if you want to be safer, you want to diversify, you don't want to pick a particular stock still out of these, then you can just start with a blue chip fund or a blue chip ETF as well. The other way, particularly to build, to pick up stocks, is to use stock screeners. This is a very easy to use thing. It is available for most brokerage platforms. We have it on the Saxo platform as well. You go for screeners and you put in some of the key things that you're looking for. For example, on the Saxo platform, I just run this with a PE of less than 20. So something that's less expensive than the markets, and dividend yields of more than 3%. So something that's been paying consistently a good dividend. So, I looked for companies listed in the US, sorted them out by market cap, and then here you go. Again, you get a list, and then you can go back and check their fundamentals, check which stories resonate with you, where do you get that conviction, and accordingly pick one of the names that come in your stock screeners.
There is a quick question here, actually, about whether you can use AI. There's two questions. I think the second question, the first one is, can you use AI to look for good stocks? The second one is around technical analysis. There's actually a series of these webinars that cover other areas of analysis. This one's really focused on investing, but there's webinars on Saxo Trader Go, which is more of our trader platform where technical analysis is the thing. So I would honestly, for the answer to that one, recommend just signing up to the next one in the series, or it might be a few down the line. But they'll cover technicals in more detail. But the AI question to find stocks is kind of interesting.
I mean, there are a lot of, I think, fund companies that are using these AI-based tools, right, to search for good stocks. I personally haven't done that, and I wouldn't recommend that for beginners as well, because, as you know, some of these AI models can hallucinate at some point of time. I would want to be, at least in the beginning, be a little bit more safer. So either I stick with, strong companies, or ETFs that are, a little bit more diversified, even as simple as something like an S&P 500 S&P 500 ETF, and some international ETF and a bond ETF, like I said, in a 3-fund portfolio. I think that's much safer to start with than to go to an AI tool and ask them for recommendations.
Makes sense.
And then let's also briefly touch upon the key things to look at when selecting an ETF, because we speak about that a lot, because that is really one of the easiest ways to get diversification in your portfolio, right? A lot of times when you want to select an ETF, what a lot of people would do is go and look at historical returns, and whenever you see historical returns, there's this asterisk along with it which says that past returns are never an indication of future returns. So always do your research. I don't particularly like the idea of looking at historical returns to understand whether I want to buy a product or not. But of course, the fundamentals is something that kind of has a better, higher priority for me. But when you're looking at ETFs, it's all about which index you want to track. That is the first step. Do you want to track an S&P 500? Do you want to track an MSCI World, or some thematic trends, some sector specific benchmarks? That will really depend on what's your market outlook, your investment objectives. And as I've told before also, we have a lot of this strategy pieces on our Saxo platform where you can read and get some inspiration for those kinds of things. The other aspects of picking up an ETF, tax efficiency is very important, specifically for those who are based outside the US. You need to consider tax implications. So US listed ETFs have a 30% withholding tax on dividends, which can impact returns. So you probably need to opt for European domiciled ETFs for better tax efficiencies. Then ETFs are also obviously priced in various currencies. Some will be in US dollars, some will be in euro, other currencies as well. And currency fluctuations can affect returns. If you are an investor who earns, say, in in euro, but you're holding a US dollar denominated ETF, then those euro dollar movements, the exchange rate movements, can either enhance your returns, but they can also erode your returns. So you have to be really conscious about the fact that you are exposing yourself to a currency risk as well if you're buying an ETF which is denominated in a different currency. You want to understand whether you are buying an accumulating or a distributing ETF. This is very, very important. Usually the ETF names, they will come at the end with ACC for accumulating, or DIS for distributing. What that means is, there are ETFs that either reinvest the dividends. So, they basically are useful when you want to just compound growth, you want to increase your investments. And the others, the distributing types, are those that pay out the dividends periodically. So those are usually good if you are looking to invest, but still have a passive income out of your investments. And then the last one that I write here, very, very important and often overlooked, is the expense ratio, or the cost considerations, basically, which is the annual fee charged by the ETF. It's a very crucial factor. Low cost ETFs will generally tend to outperform over the long term because the high fees really eat into the returns. And I'm going to just quickly come to that in a few minutes as well. But despite all of these considerations, again, you still have a lot of choice to make. I'm just going to throw in some examples here. Again, remember, this is only for information purposes, only for the purpose of familiarity. What can you consider if you're looking to invest in, say, the US? Which are the types of ETFs available? If you're looking to invest internationally, likewise, if you want to have some ETFs for your local markets as well, I'm sure you can find that. For stability and income, you may want some bond ETFs, some dividend ETFs. Then there are the sector ETFs, thematic ETFs, sustainable ETFs, plenty of choices, really. I'm just throwing in some names here for you to take inspiration to understand what kind of universe we have out there. And just the very last aspect of our discussion today, is with any service, investing is not free. The cost of investing has surely fallen sharply over the years with all these online platforms, but it is still important to ask about, to understand the fees that you're paying. Investment costs come in many, many different forms. Expense ratios is something that is the most common. That is the annual fees that is based on a percentage of your assets in a fund. But there's transaction costs. There's also a lot of hidden costs like bid-ask spreads, trading commissions. They all continue to add up. And remember, going back to the point that if you're a long-term investor, what really works in your favor is compounding, which is something very, very important. But when you have high costs, you are you're letting a part of your portfolio or your part of your wealth go into that cost, and that kind of does not really have the same benefit of compounding as it would have had if you would let it in your portfolio, right? So, I'm just going to take this example here. So, for example, on the left chart I'm showing, it's just basically a chart of saving versus investing. But if you're simply saving $500 per month, it results in a kind of a linear growth. But if you're investing that at 10% per annum, then annual return, you kind of compound it to over $1 million in about 30 years. So that's a massive growth that you need there. But on the right-hand side, and this is again a tricky thing with costs, most of the times the costs are quoted in a percentage term, right? And when you look at it in terms of percentage terms, sometimes 1%, 2% does not look that big. But when you convert it to absolute terms, it becomes really big. And more importantly, just like I said, you lose the opportunity to let that fee that you're paying to compound and add to your wealth. So, in this example on the right, we have a 2% advisory fees. For example, if you're going to an advisor and he's charging you 2% advisory fee over the period of 30 years, that is significantly eating into your return. So instead of more than $1 million, you end up making about $750,000 only in 30 years. So that's a substantial loss, right? The gap does seem very, very small initially, but over decades, it compounds. It becomes a significant difference, potentially, like I said, thousands of dollars in lost growth, really. So I think have to be really, really conscious of what fees you're paying as a long-term investor. It should work for you, not against you. And again, going back to Vanguard founder John Bogle's point, low cost index funds are really the choice to be made here, rather than paying an advisor. And even when you're choosing between ETFs, as I said on one of the previous slides, look for the cost, look for the expense ratios. Something that is 0.05% versus something that is 0.1%, it will make a huge difference in your returns over a course of 30 years or so. And with that, I have reached the end of my slides, and it's over to you, Luke.
Cool. So I guess if there's any more questions, feel free to post them. This is officially a Q&A section, but we are running low on time. So I'll just go through the questions that we got real quick. There's one from Henrik. Let me just show the question on screen. So he's asking a question: are there any ETFs which is almost as secure as cash, but with a slightly higher interest rate than savings accounts?
So there are these money market funds, of course, which are paying, I would say, pretty good yields right now, which is great. But and they're obviously very, very safe. But the challenge is really with the money market funds is that if we know we are in this rate cut cycle right now, right? The Fed is cutting rate, ECB is cutting rates. If you're in Europe, that particularly impacts you. And that with that, the yields on the money market fund. So the money market fund yields are not fixed; they will adjust to the interest rates in the economy. So I think that's something we need to be conscious about. And that's the same thing with savings banks, bank, keeping your money in the savings bank as well. It works well if inflation is going down as well. You continue to beat inflation, but you continue to be very, very safe as well in your investments. But of course, if you want to take to make sure that you beat inflation consistently and substantially, then equities is really the better choice here.
Okay. And then this isn't actually a question someone's asked, but I think it's an important one just to put out there, just to finish, I think, which is on ETFs particularly, depending on the region that you're in, there's limitations as to the ETFs that you can buy. Do you want to elaborate on that one a little bit?
So you mean the regions?
So if you're
like
in the US, so yeah, if you're in Asia or certain other countries, then you have access to more ETFs than you will in Europe.
Yeah, and that comes back down to that withholding tax that I mentioned, if I'm not wrong, and there's probably some regulatory angle as well to it. Probably you know about this, Luke, a little bit more than I do. Being in Asia, I have no restrictions.
Yeah, I think the thing is, so if you're a European investor on the call, when you go through the Saxo platform and you are searching for ETFs, some of them won't be available for you to trade, and that's just because they're not protected under European laws. And the way you can spot the ones that you can trade is they've got the word UCITS in them, UCITS. So once you see that, that means it's got the appropriate documentation, etc., for you to be able to trade it in Europe. The regulators are happy with it, and you can trade it. Now, it doesn't mean you're limited in terms of the scope and what you can invest in. Pretty much anything that you can find in these larger countries where they don't have these rules, you can find under these UCITS. But just be aware of it. If you see something that you can't trade, it's because it's not got this, and you're in Europe, it's just because it's not got the correct regulatory approval. But you can find the word UCITS inside the ETF name, and you'll be good.
And that's exactly what is beneficial for those who are based in Asia as well, because if you do choose those UCITS ETFs, those are basically domiciled in Europe, and you avoid paying the 30% withholding tax, which would be charged if you're picking an ETF that is domiciled in the US. But again, here the consideration is whether the liquidity of that UCITS ETF is as good as that of a US based ETF. The expense ratio is as competitive as of that US based ETF as well. So again, like I showed that ladder chart, there are a few things to be considered here. If the expense ratio is massively different for an Asian investor, I would still go for a US based ETF rather than a UCITS ETF. But if the expense ratios are comparable, I might as well save on that withholding tax and choose a UCITS ETF instead.
Cool, makes sense. So I think that's a wrap. I think just to finish off here, I'm going to put a QR code on the screen. I'll put it back on and I'll just leave it there. So it's basically just if you are able to get to the website underneath it, it's just a feedback form whereby you guys can say if you enjoyed the webinar and if there's any other topics, for example, that you would prefer us to talk about in future. But thank you very much for joining. And thanks, Charo, for hosting. That was really, really good. Really enjoyed it. And just a reminder to everyone online, you can watch the recording through the same link you used to join, or you can find it on the Saxo platforms. So thank you.
Thank you, everyone. Good day ahead.